Hello everyone, welcome to Anu's classroom. This is the last unit of MMPC 3 unit 13, sources of global financing. So we saw in the last session that the international trade or foreign trade is an integral part of the world economy. No country can survive without partaking in this foreign trade. So however, trading across national borders will definitely involve its own costs, which are to be incurred by the domestic exporters or importers, and such as like the cost associated with the shipment of merchandise, import payments, cost associated with selling of goods to authorized third parties of sale, and things like that. So in due course of time, and with the strengthening of this cross border relationships among trading partners, various sources of trade finance have come up, which may ensure complete safety to both the importers and exporters of a country, the most important among them being the strengthening of global financial market operations. So in this unit of MMPC 3, we will make you familiar with the various sources of global financing that a country can opt for while it is engaging in cross-border trading. So as such, we will make an attempt to understand the various sources of global financing which a country can opt for, foreign direct investments and foreign portfolio investment, how international money markets function, what are the trends in India's global sources of financing as well. So as such, we will start our discussion with foreign direct investment. Foreign direct investment or FDI can be defined as an investment which is made by an individual or a firm of one country into the business interests of another country. In general, FDI occurs when an investor sets up business operations or purchases assets in a foreign company. If an American multinational company, let's say for example, intends to set up its operations in India or maybe New Zealand, either by partnering with a local firm or by opening up its own branch, then it is considered as a foreign direct investments. Okay, FDI. FDI can be done in multiple ways, which may include entering into a merger or joint venture with a foreign enterprise, or opening of a subsidiary or an associate firm in a foreign land. The threshold for an FDI to establish a controlling interest in the business making decisions of the foreign company is set as per the guidelines of the Organization of Economic Cooperation and Development, OECD, which is a minimum 10% stake in the foreign based stake. FDI is commonly categorized as horizontal FDI, which refers to an investor establishing a business operation in a foreign country similar to that operating in the home country. For example, say a cell phone provider in the US is opening its store in India. That is a horizontal FDI. Then we can have vertical FDI, which refers to setting up of different business related activities from the investor's main business. That is, for example, if there is a manufacturing company in US and they wish to set up a company which supplies raw materials or parts, or may wish to merge with a local company supplying materials in the foreign country, that is vertical FDI. Okay, then we have another type of FDI which is called the conglomerate FDI, which is a type of FDI in which company wishes to make an investment in the business in a foreign country which is not at all related to its current business in the domestic country. So such an investment by an investor will not involve any prior experience, and they usually opt for a joint venture in the business that is already operating in that foreign country. Like for example, a cell phone manufacturing company in the US is entering into a textile company with in India. That is a totally different thing, right? So that will become a conglomerate FDI. Now, the other thing is the foreign portfolio investment or FPI. Portfolio investment refers to investments by residents of one country in a foreign country's securities, which could include shares, bonds. That could be bonds could be both government or corporate bonds, convertible securities, infrastructure securities, and things like that. And those investing in these securities are termed as foreign portfolio investors. So FPI is one of the major components of the capital account for a country and is reflected in the BOP. It consists of passive ownership, unlike FDI, where investors do not have any control. Okay, in FPI, investors do not have any control over the ventures or direct ownership of property or any kind of a stake in the company in which they are investing. In case of India, Securities and Exchange Board of India (SEBI) has stipulated the criteria for FPI to be less than or equal to 10% of capital in a company in the year 2016, while above 10% will be considered as FDI. Another type of global financing is the external commercial borrowing or ECB. It is defined as the commercial loan which can be in the form of, let's say, bank loans or securitized instruments like floating or fixed rate bonds, partially or export or optionally or non-convertible preference shares, buyer's credit, supplier's credit, which is availed from non-resident lenders and all, with a minimum average maturity period of 3 years. So, when should we opt for ECB, or why should we opt for ECB? ECBs are allowed by our government of India, as source of financing existing as well as new investment projects at a much cheaper rate. That is one reason. ECBs are mainly encouraged in the infrastructural areas like say telecom, railway, power, urban infrastructures, as well as in small and medium enterprises. So that is why they also will tend to prefer ECBs. ECBs can be assessed under both automatic and approval route. So those that are assessed under automatic route will not require any approval from the Government of India or Reserve Bank of India. And such ECBs are usually applied for investment in the industrial sector, infrastructure sector, or some specified service sectors in India. And the ECBs which come through approval from RBI or Government of India will fall under the approval route. Similarly, ECBs have another advantage like diversification of the investors' base and providing international recognition to those companies. At the same time, these ECBs, they also have few disadvantage like that ECB tend to increase a country's external debt and as a result increases the borrower's foreign exchange rate risk. Such foreign currency fluctuations may lead to a loss which may succeed the savings in interest costs. To avoid these, there is a capping set on the ECBs in a financial year and an overall cap on the ECBs in different sectors also, which are subject to change by the Reserve Bank of India or Government of India as they see fit. We also have international money markets. So the reason why we have these international money market is to make the financing for international trade easier. How? Through facilitation of borrowing of foreign currencies for financing imports or debts. So the international money market, they usually comprise of the euro currency market, which is any freely convertible currency deposited in a bank outside the country of its origin. That is termed as euro currency. So if the US dollar, for example, is deposited in a bank in London or Singapore, it will be termed as euro dollars. So far, we don't have a euro rupee market though, as per my knowledge, in case if you're wondering, right? So such banks which accept these deposits and facilitate loans in foreign currency are termed as euro banks. We also have euro bond market, which is where euro bonds are traded in any freely convertible currency outside the country of its origin. Euro bonds are either frequently grouped together by the currency in which they will be denominated, like euro dollars or euro yen bonds. And the significance of this euro bonds is that they help organizations or countries raise capital with the flexibility of issuing them in another currency. The issuance of these euro bonds is usually handled by a depository bank or an international financial organization on behalf of the borrower, which will underwrite the bond and take guarantee of purchasing the entire issue. We also have euro notes and euro commercial papers. So the euro banks, which we saw right in the first point, euro currency market, we saw about euro banks. So these euro banks, what they do is they can issue short term note issuance facilities, okay, or simply note issuance facilities, we can say, as a low cost alternative to these euro bonds, which will permit the borrowers to issue their own short term euro notes that is distributed by these euro banks to other foreign countries or companies apart from the borrowing country or company. So these are short term debts which are issued by large corporate houses with excellent credit ratings. So these are the three ways or three types of international money markets which are present. Now, any kind of assistance which a country voluntarily accepts or transfers to another country, say in the form of gift or grant or loan, is something that is known as foreign aid. These foreign aids are also an important source of foreign currency, right? Foreign exchange. So this foreign aid is usually offered by developed nations to that of to the developing nations or the least developed nations during times of natural calamity or say economic crisis or during some sort of political instability and all. So an international aid can be granted either as an FDI or in the form of a humanitarian assistance from wealthier countries which are usually provided in times of natural disasters or political instability or say severe economic crisis and all, or it could come in as through engaging in foreign trade or a bilateral aid where the government of one country would be transferring money to another country in kind of assets which are directly given to the recipient country, or it could come as military aid, which is also a form of bilateral aid in which nation involves in purchasing of arms or signs direct defense contracts with the US. There could also be multilateral aid similar to bilateral aid, but it will be provided by many governments instead of just the one to the recipient country. In this case, single international organization like World Bank or IMF and all, they collect funds as donated by the governments of different countries and they will transfer the same to the recipient country. So that is how foreign aid works. We also have something called as a concept called as trade financing. So trade financing represents the financial instruments and products that are used by companies to facilitate international trade and commerce. This trade financing makes it possible and as well as easier for importers and exporters to transact businesses through trade. Some of the typical trade finance which is commonly used in India are the term loans, working capital limits like overdrafts, cash credits and letters of credits and all. So there are 5 principal means of trade financing in which are being ranked in terms of its increasing risk to exporters. Cash in advance is there, which offers the greatest protection to the exporter. Why? Because transactions are done mostly in cash, either before or after the arrival of goods. We have documentary credit or documentary letter of credit, which is a form of letter which is addressed to the seller or say the exporter, which is written and signed by a bank acting on the behalf of the buyer or the importer. And in the letter, the bank will promise to honor the drafts that are drawn on itself if seller conforms to specific conditions which are mentioned in the documentary credit. So there are the major types of documentary credit are revocable DC, irrevocable DC, confirmed DC, unconfirmed DC and transferable DC. Once I guess I have seen a question in one of the term and examination papers wherein they had specifically asked to write short note on documentary credits. So in that case you will have to write down what each of these documentary credits are actually there. Okay. Yeah, so drafts again. Draft is another form or instrument of trade financing. It is an unconditional order in writing which is usually signed by the seller or the exporter and addressed to the buyer or the importer or the importer's agent also, ordering the buyer to pay on demand or at a fixed future date the amount that is mentioned on the face. It is also known as bill of exchange. So again, drafts also, it could be sight drafts, time drafts, clean drafts or documentary draft. Then we have another type of trade financing tool called as the consignment, where goods sent are only shipped, but they are not sold to the importer. Okay, you're understanding the difference. The good is being shipped out, but it is not sold to the importer. So in this kind of arrangement, what happens is that the goods are left in possession of an authorized third party to sell, and this exporter or the consigner on selling of the goods in the consignment will draw a portion of the profit either as a flat rate fee or as a commission. An open account selling, on the other hand, involves shipping of goods first and then billing the importer at the later date. So the credit terms are arranged between the importer and the exporter, and in these kind of arrangements the exporter actually does not have much information about the importer's obligation to pay. And therefore this open account selling, being the riskiest of all the trade financing options when it comes to the exporter, is usually preferable when the foreign affiliate or the customer with whom the exporter has a long history of favorable business dealings are there. If the exporter and the seller and the buyer are in good terms, in a very long relationship it is there, only then they will agree for this open account trade financing, otherwise they will not go. Now, another important concept in this particular video is the American Depository Receipts or ADRs, which again had come up in term and examination as like a short note question and all. Sometimes it pops up. So this American Depository Receipt is a negotiable certificate which is issued by a US bank, and it represents a specified number of shares of a non-US company which is being traded on a US exchange. Now they are measured in US dollars and they are transacted in the US stock market, similar to stocks of any other US company, and they are issued in US by a US bank also. ADRs are listed either in the New York Stock Exchange or in the American Stock Exchange, or even it could be listed in the National Association for Securities Dealers Automated Quotation, NASDAQ. ADRs offer the US investors an opportunity to purchase stocks of foreign companies in the US market in US dollars. On the other hand, it benefits the foreign companies by enabling them to attract American investors and trade its share in the US market without the hassle or expense of listing in the US stock exchanges. When a foreign company enters directly into an agreement with the Depository Bank of US for maintaining records, communicating with the ADR holders and payment of dividends and other shares, then it will be called as a sponsored ADR. And when there is no involvement of any US depository bank and the foreign company wishes to establish itself in the US trading market with the help of, say, a broker dealer, it is called as non-sponsored ADR. So these are the two types of ADRs, sponsored and non-sponsored. In the case of sponsored ADRs, the US depository bank facilitating this will charge a fee, and while making an agreement with the foreign company for rendering its services to the ADR holders. And this fee is called as the custody fee, and it is often deducted from the gross dividend by the foreign company, and the net dividend will be paid to the ADR holders. There are three types of ADRs. There is level 1 ADR, which does not intend to raise capital. They are just listed in the exchange and traded only over the counter market. There is no information about the issuer company in the US Securities Exchange Commission. We have level 2 ADRs, which are either listed on an exchange or it is quoted in NASDAQ. They too, like level 9 ADRs, do not wish to raise capital, but they are required to file annual reports in the US Securities Exchange Commission. Then we have another level, the third level of ADR, which is the most important category of ADR. It is issued to raise money as well as trade in the US exchange market. But they are also required to file annual reports to the Securities Exchange Commission. The next type of global finance is Global Depository Receipts, GDRs. A bank certificate, it is a bank certificate which is issued in more than one country for shares in a foreign company. So that is why it is called as a Global Depository Receipt. Earlier what we saw was American Depository Receipt. It is particularly for America. When we come to Global Depository Receipts, it becomes what you can say, it is given in more than one country. Okay, so they are listed in 2 or more markets, mainly in the US and the Euro markets, and are denominated in a freely convertible foreign currency. So a foreign company could issue the shares to a depository bank for of the share trading country, and the depository bank will then issue this global depository receipt against the shares to the investors of the other foreign countries. And in case of global depository receipts, the GDR holders are not shareholders of the share issuing company. The depository bank is who becomes the main shareholder of this issuing company and also has voting rights. Okay. Now, when we talk about the trends in India's global sources of financing, the details that I present to you now is based on what I understood from various articles online. Why? Because I did not feel like what was provided in the coursework actually relates to the topic. So, if you can spare some time, I request you all to go online and do some research on your own as well, because doing these kind of research, small researches on our own will give us a totally different kind of learning, which I think is far more superior to just mugging up some textbook or some notebook. Okay, so anywho, we say that the change is the only constant in the world, right? So we get used to something and it just changes drastically in one fine morning, and then we will again be left off with having to relearn everything in the new world. Global financing is also not something that is much different. Okay, it is also something that follows this concept of constant change. To name a few trends in this sector, we can say about ESG investments, which is short for environmental, social and governance investing. So globally, what you can say, when you look at it, there is a very strong demand for all the companies to go green right now, all over the world. Consumers have called for ethical products and services which have a positive impact on the ecological system. Have you ever seen women's makeup products? Earlier it was just cruelty free. Now if you look at it, there is a list of what all free is there, right? That is, so this is all what you can say, I feel like it is all trying to make the consumers feel less guilty about their products, right? Anyway they are mass producing, they are mass advertising, we are bombarded with products every nook and corner, that we are actually being coerced to buy, right? Mm. And shopping has become one of the most favorite pastime activities for most people, including me, right? If I go into a shop, I cannot just come out without buying at least one thing. So how do the consumers become, what you can say, consumers are all these things are to make them feel less guilty about spending their money on things, right? Or spending unreasonable amount of money sometimes on certain things. So all over the world, you can say, consumers have called for ethical products and services with a positive impact on the ecological system. So this has led to financial advisors also to push for these ESG investments for the clients as well as companies, right? So what is happening here? Similarly, artificial intelligence is also taking over the world. Finance included AI frameworks can help you make informed trading decisions, look for interesting investment opportunities. Conversational AI tools are there, which ensures that customers receive personalized and friendly interactions as though they are chatting with a friend, right? Automation ensures all banks immediately made aware when a fraud is taking place, and it stops the transaction. Processes are made more efficient, unnecessary tasks are eliminated, financial services get a highly efficient and advanced upgrade. Earlier generations may remember what it was like to feel each pocket to find a spare change for a cab fare. Some could also recollect checking the folds of a wallet for full money, the full amount owed to a delivery man, right? But now all we need to do is locate our mobile phone. Google Pay, everywhere it is Google Pay. Even in a chai kada, you can do Google Pay now, right? Chai kada means tea stall, okay? Now you only need to have your phone. That is more than enough. As one of India's most successful trends in financial services, we have the payment apps, which have radically changed the way we pay for goods and services. We have Google Pay, we have Paytm, Phone Pay, Amazon Pay, all these things, right? Each bank has its own payment app. SBI has Yono, HDFC also has something, right? They are all very familiar apps to almost everyone, right? And they have become such an intrinsic part of our lives that it is very hard to imagine a time without them. They can lead to further exciting possibilities in finance as well. So we are surrounded by hyper personalization, cloud computing, blockchain technology, and we hear about mergers, joint ventures with foreign companies more than ever before. More and more companies are listing themselves in the stock market. A few days back only, I got an email regarding even Mama Earth going public. You have heard of Mama Earth, right? I think it is Shilpa Shetty's brand. So do comment down below what other trends you have found out as trending in the global financing market, okay, of India. I hope to see your comments. So also we are winding up this unit 13. I would appreciate if you could list a few private equity companies that have invested in India in the comment section. No pressure. In case you get time while you're quickly studying for your term and examination, in case you do get time, just note down in the comment section, otherwise ignore it. So I hope to see your comments. Thank you all for choosing Anu's Classroom as your study partner. And so this is the second last video. We have one more unit in this MMPC 3, that is unit number 14. So with that, we can wind up our MMPC 3 course. So until I see you all in the next video, thank you so much. Take care. Bye-bye.